What a start to the year it has been. The equity market surprised to the upside with the S&P 500, Dow Jones Industrial Average, and Nasdaq indices all hitting record highs in 2024. The S&P 500 is plus 15.08%, and the Nasdaq is up 20% year-to-date as of June 25th. This is an unbelievable return, particularly on the heels of a very strong 2023. We're seeing many analysts just now catching up to this bullish trend and changing their price targets. So the question now is, will the momentum continue? We think so. We expect volatility over the short term, but we believe that we remain in a long-term secular bull market, and the stock market should continue to move in a positive direction despite potential short-term volatility. So in this video today, we will recap what has happened year to date and what we expect to happen for the remainder of the year.
The adage "sell in May and go away" did not ring true in 2024, as many stocks like Apple, Microsoft, Google, and Broadcom set new highs in May and then again in June. This can be attributed to better than expected Q1 earnings and favorable economic data. Why do we expect short-term volatility? We believe parts of the equity market are approaching overbought conditions. This normally leads to an increase in volatility and potentially a correction in stock prices. Stock prices eventually realign to their intrinsic value though, and then go on to set new highs if they can continue to grow their earnings. As we predicted in our Q1 market outlook, we saw the S&P 500 decline 5% in April, and then eventually set new highs in May. This is a normal and healthy process for the stock market. Historically, the S&P 500 pulls back 5% roughly 3 times a year, and 10% about every 16 months. Our medium to long-term view is bullish, so we view short-term pullbacks as buying opportunities for high-quality companies.
As of this week, investors are expecting the first interest rate cut in September. But what will actually prompt the Federal Reserve to finally cut rates? Fed Chair Jay Powell continues to state that FOMC wants full confidence that inflation is trending sustainably lower prior to them cutting interest rates. That likely means several months of disinflationary data. While many investors are eager for a flurry of interest rate cuts, we favor a gradual and planned course of interest rate cuts. Why? Cutting rates quickly would be a sign of significant deterioration or breaking in the economy, which could be more troubling than inflation running a little hotter than the Fed's target rate. And cutting rates prematurely could spur additional inflation. It is clear that economic growth has slowed over the last few quarters. Initial jobless claims are increasing and unemployment rates have increased modestly. Meanwhile, retail sales data is softening and new housing starts are also declining. But this was expected given the higher interest rate environment over the last 2 years. The Federal Reserve's restrictive monetary policy is having its intended consequences on the economy. So what does all this mean for investors? A gradual slowing of the economy, along with a gradual decline in inflation, could give the Federal Reserve the confidence to cut rates soon.
The second quarter earnings season is just around the corner, and we believe corporate earnings are the most important driver for the equity markets. Earnings continue to grow this year with an 8% growth rate in the first quarter, and estimates are on the rise. S&P 500 profit margins have remained stable, landing at 11.5% in the first quarter, and that's despite sticky inflation and elevated interest rates. We expect the major themes in the second quarter to continue to be AI-related capital expenditures and the strength of the consumer. Now, clients and investors are asking, what about the election? As we near the presidential election in November, remember, historical data suggests that economic and inflation trends, more so than election outcomes, tend to have a stronger and more consistent relationship with stock market returns. In fact, since 1926, stocks have continued higher regardless of which party has been in the White House. The S&P 500 has averaged 11.6% in presidential election years. Now, if you're interested in more election-related and Washington, D.C. insights, be on the lookout for our next quarterly webinar, which will be on October 24th with Scott Eckel, the Legislative and Regulatory Affairs Managing Director at Charles Schwab.
As always, thank you for putting your trust in our team. It's a responsibility we do not take lightly. If you have any questions or if there's anything else we can be doing for you, please reach out. Wishing you and your family a happy 4th of July.